Hi everyone, Nick here, welcome back. One of you recently asked me, Nick, have you ever heard of the OMFL ETF? It's a factor investing ETF with great performance of price growth and dividend growth ETF that has beaten the S&P 500 by 17 to 18% in the last 5 years. I'm interested to see your opinion on it. It sounded quite interesting, but I never heard of this ETF, so I decided to look into it a little bit. And as I started to look into it, I found it to be quite interesting, and I discovered some risks that I think many people are overlooking. In this video, I'm going to walk you through how this ETF works, what those risks are, and my opinion. OMFL is part of a series of complex ETFs that are Invesco Dynamic Multifactor ETFs. These are all based on Russell indices. And they all apply a multi-factor tilt, which is based on academic research, which showed certain types of risks you can gain unique exposure to via different companies. And historically, that research found that you were rewarded for taking these extra risks. I made another video specifically on this subject, which I'll link up here and below for more detail. These ETFs apply a tactical asset allocation. The idea is that you can adjust your asset allocation in response to changes in the economy or the market. This is done with an algorithm. So they specify specific criteria that will change the investment portfolio as market sentiment or economic conditions change. Here's a paper on dynamic multi-factor strategies, which I'll link below. The general idea with these funds is they track what are called regimes, macro regimes, and factor cyclicality. So there's these 4 regimes: recovery, expansion, slowdown, and contraction. And they adjust exposures to the different factors based on this. For instance, in recovery, they emphasize size and value factor. But then in expansion, they add in the momentum factor, and so on. So they have these indices, and they tilt them towards these factors in response to changes in market conditions. If we scroll down, they did some back testing on these strategies that was quite interesting. And in here, they're saying their back tests showed a 4 to 6% return over the market indices by applying these strategies. So if you look at the graph, this is a very significant difference in return going back to 1989, with this dark blue line being the strategy. Now, who wouldn't want that significant extra return from a strategy if it existed? So we can look at Portfolio Visualizer going back to when the fund was founded in late 2017 or early 2018. And since then, if we compare it to the Vanguard Total Stock Market Index, which is in blue, this dynamic multi-factor fund is in red, and it did significantly outperform the Vanguard Total Stock Market, which only returned 9.7% compared to the 12.85%. That's over 3% extra return since this fund was founded. One of the concepts with risk is higher risk is generally correlated with higher return. Doesn't always mean when you take extra risk you get higher return, or we'd all become very wealthy just by going to the casino. It's a lot more nuanced than that. Now, factor investing research from Eugene Fama and Ken French found that historically a lot of these factors did result in an extra return, which was explained by unique risks that they were exposing in the portfolio. These types of multi-factor funds are designed to go after these extra risks and hopefully deliver an extra return. Now, since the research was published, a lot of that risk premium diminished, and a lot of these investors have been underperforming the total market index for a couple decades. However, this fund layers on an additional strategy, which is kind of like active management using an algorithm to change the tactical asset allocation in response to market conditions or economic indicators. There's a couple other risks I think we need to talk about. The first one is related to active management. If we look at this SPIVA report covering 10 years of active funds compared to the indexes from 2012 to 2021, only 15% of actively managed funds outperform the index. Now, if we go up to 20 years, that changes to just over 3% of funds that were able to outperform the index from 2003 through 2022. Now, if we were to bump this up to even 40 years, I don't have the research on this, but I would speculate that it is well below 1%, 1 out of 100 actively managed funds that would outperform the index. This is a major risk we take on whenever we invest in actively managed funds instead of the index. Will that extra risk result in a higher return? And is it fair to call OMFL an actively managed fund? It's based on an algorithm that's data-based in response to indicators and economic conditions. However, isn't that what actively managed funds do? They have investment managers that have finance degrees, study the market, teams of researchers, and so on. They have access to these same types of things. They're able to be more dynamic, possibly more biased than an algorithm, but I think the approaches are quite similar. So I would put this as an actively managed fund from my perspective. Another risk I think we need to look at is looking at this historical study from Dalbar showing the average equity fund investor versus indexes over 30 years from 1993 through 2022. And the index returned 9.65% annually, while the average equity investor only gained 6.81% annually. That's a big difference. If we look at over 40 years of investing, starting with $1,000 and investing $500 per month, the market would have returned a portfolio of nearly $3 million, $2.89 million, while the average investor would have got less than half of that portfolio, $1.25 million. That's over a $1.6 million loss compared to just investing in the market index. Now, the ideal is that they would outperform the market index by a similar amount. If they have some investing savvy, they're able to pick the hot funds that deliver the higher returns. And if they were able to do that for 40 years consistently, it would pay off handsomely, delivering over a $7 million portfolio and a $4 million excess return over the index. So the big money question is, are you going to be more like the average investor that loses over $1 million trying to pick different funds? Or are you going to be the investor savant that crushes the index and gets the extra $4 million? That we don't know. Odds are not in your favor, especially considering that investment professionals running such actively managed funds underperform the index over 20 years. Only 3% of funds are able to beat the index, and in over 40 years it would be even worse. So we don't know if by investing in these Invesco multi-factor dynamic ETFs you're going to outperform or underperform the market. It's really a gamble. In the past 5 years it would have paid off. However, we do know some things. What is certain? We know that it has a higher expense ratio. This is a transparent expense that's just deducted from the fund's return. You don't pay for it directly. So if you see the fund deliver a 12% return, that's after the expense. It would have been 12 plus whatever the expense ratio is. These funds also have a higher turnover, and this fee is not transparent. This is when the fund is trading in and out of stocks. They're paying commissions and other types of fees to brokers and so on. Now, I wasn't able to find these direct fees in the fund's literature. Maybe it's there and I missed it. But instead, we're going to use this study that Forbes was talking about to estimate the cost of the turnover for the fund. And this study found the average reduction in annual return per 100% of turnover was negative 0.41% for U.S. large cap equity funds, negative 0.53% for U.S. mid cap and small cap equity funds, and 0.87% for international stock funds. Now that is a massive drag on the expenses. When you're looking at a fund like this that has, I think, a 0.29% expense ratio, when you start adding in turnover, this fund's turnover last year was over 300%. And it's kind of like a large cap fund. It has some mid cap. So I think we could just split the difference and say it's about 0.45% for each 100% of turnover. We'll look at that in a minute. So if you own this fund in a taxable account, you'll most likely have to pay higher taxes. Most investors would, because the distributions this fund has made in the past have all been ordinary income, where a normal index fund like VTI pays all long-term capital gains distributions so far, which are taxed much more favorably than ordinary income. Next, when you're trading this ETF, it has higher bid-ask spreads, which is basically like a broker commission baked into the trade. The fund also has a higher premium and discount than VTI. And this is another cost that's basically baked into the transaction. I covered more details of these ETF costs in my video on mutual funds versus ETFs if you want to learn more. You can also look these up to compare different ETFs on ETF.com. So when we add all these different costs or expenses up, it's quite drastic when you compare it to a fund like VTI. First, the expense ratio is over 0.25% higher. That's very transparent. The turnover is where it gets quite interesting. And I'm estimating the turnover. Like I said, I wasn't able to find this in the fund's literature, but when I just took the last 3 years of turnover, it was 321%, 126%, and 336%. We have a 336% turnover. That means that the fund basically cycled every single holding in the portfolio over 3 times in that year. That is a massive amount of trading. So I just average these over 3 years to get 261%. We compare to VTI, the index fund, the turnover is extremely low. It keeps the cost very low. And I just used the study, which had the 0.45% fee, or 0.41 for large cap and 0.52 for small and mid cap. I just split the difference at 0.45 for this estimate. So when we look at that, that's a massive difference, almost 1.2% extra, 1.15% extra you're basically paying in these trading fees. And then taxes, I was just estimating the taxes. If we look at that, just estimating it based on an average tax rate of 22%, you'd end up paying a little bit higher in fees. Now, if you're in a higher tax bracket, like the top tax bracket, that would be a lot different. But then the spread average and the premium discount average, those differences are a little low, but they do add up. That's almost the entire fee of VTI that those add up to. So that's a pretty big difference. When you're at about a 1.53% estimated extra cost you're going to pay every year to invest in this fund. So just to break even with VTI, it has to outperform VTI by roughly that amount. And that is an incredible undertaking that this fund would have to take. It has done it in the past few years, but that is a high bar to overcome. So when we talk about risk, we have to look at risk and reward. And these are the facts that I think are most important to judging these risks. OMFL outperformed VTI by 3.17% since 2017. OMFL costs are almost 1.5% higher than VTI. OMFL is similar to an actively managed fund. It is using an algorithm based on some fixed criteria, but it is similar in that it is adjusting the portfolio as economic and market indicators change. As we saw, 97% of active funds underperform the market over 20 years. The average equity investor underperformed the market by 2.81% over the past 30 years. So these are some of the facts I think are most relevant to consider. So I'm going to ask you a hypothetical to think about this risk. So what is the risk you're willing to take? Let's say you have option 1, which is a guaranteed $3 million retirement portfolio. Or let's say you have option 2, where you have a 3% chance at having a $7 million retirement portfolio, or a 97% chance of having a $1.25 million retirement portfolio. Which one of these options would you choose? So I want to add some context here. If you go to the casino and you bet on roulette, where they spin the wheel, the ball lands on a number, and each number has a color too, so you can bet on the color or the number. But betting on the number, you have a 1 out of 37 chance of picking that number correctly. That is a 2.7% chance. So would you be willing to basically spin the roulette wheel and pick which number it would land on to determine if your retirement portfolio was 7 million or 1.25 million? Or would you just take the 3 million and walk away and call it good enough? Well, I don't think it's going to be quite this extreme. I actually think this is roughly the gamble you're making when you decide to invest in actively managed funds, move in and out of different funds with market timing, and so on. Maybe you'll only underperform a little and only end up with 2.5 million, or maybe you'll outperform a little and end up with 3.5 million. However, the point remains, when you're investing on a 30, 40-year time horizon and compounding that money each year, just 1% of under or overperformance can have a 7-figure impact on your retirement portfolio. That's basically a 7-figure gamble you are making. So are you confident in that gamble? Do you know something that the market doesn't? Are you confident that the algorithm used by your fund or the fund managers will beat the market? There are millions of people out there trying to beat the market, including professionals that do this for a living, PhDs writing automated trading software, hedge fund managers, mutual fund managers, and even these people fail to outperform the market over the long term. So do you really think that you have an edge in selecting an ETF that will? That is the question that I think is relevant, and the stakes are extremely high. Like I said, it may not turn out this extreme, but this is what we saw. The average investor would have ended with the 1.25 million portfolio, while just taking the market return would have been 3 million. So most investors, by trying to swing for the fences and get that $7 million portfolio, they end up with the $1.25 million portfolio instead. So this is, in summary, my opinion. Dynamic ETFs are interesting. I think the concept is quite interesting. It's interesting to have an algorithm, some sophisticated math formulas and back testing that says this strategy did very well. However, these ETFs have done very well since 2017, but it is uncertain if that performance will continue. If it's anything like all the other actively managed funds on the market, the odds are very slim that that will continue for the long term. So you're hoping that you get out in time and switch into another one. So will OMFL outperform, or will it end up like the ARK funds? And if you were an investor in the ARK funds, did you get out in time? So there's certainly about 1.5% higher cost by my estimate by investing in these funds. And it is a possible 7-figure gamble with what I estimate to be less than a 3% chance of winning over the long term if you're trying to pick funds like this. We only get one chance at compounding our portfolio for 30 or more years. If you screw that up, you've lost some very valuable years for that compounding. If you look at just taking the market return and compounding it instead of 30 years for 40 years, that difference is massive, and it magnifies the longer you go out. So if you start off with these types of strategies for the first few years, then figure out, oh yeah, I'm actually not as good at this as I thought, you've lost some of those very valuable years. And the risk of underperforming the market, in my opinion, is just not worth it. I think the best way to build wealth is to focus on growing your income, consistently investing for the long term in a well-diversified portfolio of market-weighted index funds, like the 3-fund portfolio. It's a very simple, elegant portfolio. I made a video on it, which I'll link up here and below. Financial fads are popular, especially on YouTube, where people hype up something that recently did well or sell a story of why something's going to outperform. I believe this is why the average investor underperforms. They're too focused on the hype and these stories and the recency bias from what did best last year, the past 5 years. Now, certainly some people will be successful, but most will not, as we saw from the data. I think these fads are the equivalent of cigarettes for your financial health and should be avoided. If you got value from this video, make sure to hit the like button and subscribe and share it with your friends to support free financial education. Thanks for watching, everyone. Later.